Joining me is Jane Coffey, Head of Equities at Royal London Asset Management, and Matthew Fell, Director of Competitive Markets at the Confederation of British Industry. Matthew, if I could start with you, is this a move that's necessary? Is this a move that's too risky? Britain's going it alone. Is it right to do so?
Well, let's be clear, the sort of fundamental starting point for businesses, they want a more stable and more resilient banking system, but they're equally clear that this is a fundamental and substantive set of reforms put forward by the Vickers Commission today. So the message from business is very much that these need to be looked at very carefully and implemented in a way that can support the economic recovery and make sure that lending to business continues.
Jane, if we look at this, they're not about making banks maybe more attractive to an investor, and certainly in the short term it would appear that they would make them more competitive, less competitive rather, and that from your point of view less attractive.
Yes, I think from an investor's point of view, either as an equity investor or as a bond investor, this doesn't really make banks more attractive. It makes them less likely to be able to earn the returns that you would anticipate or that you would look at in the past and see them having earned. So therefore, I wouldn't expect this to be a positive for share prices or for fundraising in the market.
Now, what do you think of the idea that we've got Basel III in place? That's something that is being done internationally. Mm-hmm. Is it right that the Vickers Commission has decided that British banks should have this extra capital buffer that obviously allows them to be perhaps safer, but certainly less competitive?
Well, I think it's particularly difficult for those banks that are competing internationally in their investment banking side to find competitive funding. So for RBS and for Barclays for their international banking, then there is a competitive problem here. Their cost of funding is probably higher than those other banks who are being able to use the retail deposit base as well as across the bank for their funding.
Matthew, in terms of competition, surely this is going to be detrimental to UK business?
Well, I think it's important if we look at the overall competitive position for UK business. I think one of our major concerns is there are a number of reforms put forward in the Vickers Commission today that do suggest the UK is going it alone. We're the only country really actively pursuing a ring-fencing option, for example. The capital reforms go above and beyond what has been set out in terms of international reform. And I think our concern there is that those will all equate to additional pass-on costs for business, so it will increase the cost of lending and reduce the choice and availability in the short term that's available to business. And that's why we're particularly keen to see these reforms introduced over a period of time when the economy is resilient enough to withstand those extra costs.
George Osborne actually said today, this is good for business. This is about getting banks to be able to lend to businesses. He's all about trying to get growth. Do you think that this is misplaced, or do you think that if it's done over the time frame suggested to 2019 that actually it may be able to work without hurting businesses?
Well, I think we heard two key things from John Vickers today, and that is the questions about how and when. And I think we had some encouraging signs on both of those. If you think about the how question first, we got an indication that there will be more flexibility in the approach to how banks are able to implement the ring fence. And on the question around how, as you rightly say, the implementation timetable goes through to 2019, which one is in step with other international reforms, so that is helpful so that banks can plan for and phase in the reforms in step with those. And then more importantly, that will hopefully be able to make sure we can implement these changes in a way that's consistent with where the economy is strengthening and recovering, and therefore we should be in a much better position to withstand the impact of these, so it shouldn't interrupt lending to business if it's implemented in a clear and sensible way.
Jane, when we look at investment, of course, not all banks are equal, are
Absolutely.
they? And some banks are going to be affected more than others. Which ones, from your perspective, are going to be worst hit by these measures?
Well, I think from today's measures, the Barclays and RBS are going to be the worst hit, are going to have more implementation costs than, for instance, Lloyds or the banks that are more dependent on overseas business, for instance, HSBC or Standard Chartered.
And when you look at HSBC and Standard Chartered, and indeed all of them, how easy is it for them to shift some bits of business offshore. I mean, there's this kind of spectre that's waved every now and again that the banks will simply move and they'll all be, they'll all be working out of Switzerland. That's obviously very unlikely to happen. But is it not the case that some bits of it could just simply be moved away to avoid this?
It's certainly true that some parts of it can be, and particularly the investment banking side, where you run your derivatives books, where you put your profit centres for internationally traded ETFs or something. That is something that could go anywhere, and that will obviously also affect the amount of tax that the UK government gets from the banks when they are back into profitability. So I don't think banks would take this at all lightly as far as moving suddenly, but they are all reviewing it. The costs of moving are obviously very big, and it's very disruptive for their people, and people is one of the main assets that a bank actually has as far as giving it a competitive advantage. So,
from the CBI's point of view, that very point about some business leaving the UK, I mean, that has knock-on effects both in terms of income tax revenue and indeed in terms of everything to do with business, really, doesn't it?
Well, I think that's right. Our top priority and top concern today was what this is going to do in terms of availability of finance for business. But we should also remember that the city and the financial services sector is a very important contributor to the UK economy in its own right, employing over 1 million people, contributing close on 10% of GDP annually. So this is a major world-class sector that we have here, and we would send out signals that it's not welcome at our peril.
Now, finally, I just wanted to ask you both, the point of all of this, of course, is to make banks safer. From what you've seen today, does this make banks safer?
Well, I think the jury is still out on exactly how and when the ring fencing proposals in particular will add to the resilience of banks. And I think that's where we really need to see a very rigorous cost-benefit analysis from the government in the coming months to be able to properly nail that issue.
Jane, from your perspective, does this make banks more safe?
My concern is that actually the banks that went under were nothing to do with investment banking when we did have the 2008 crisis, and in fact it was Northern Rock and HBOS's retail side, and in the US it was the regional retail banks that all collapsed rather than the investment banking side, bar Lehman. So. Having more capital will obviously make the system safer, but whether they have really focused on the riskiest businesses and costed that correctly, I'm not too sure.
OK, Jane Coffey, Head of Equities at Royal London Asset Management, and Matthew Fell, Director of Competitive Markets at CBI. Thank you very much indeed for joining us.